Let's welcome in our market master of the day. Sunil Koul is Global Emerging Markets Equity Strategist at Goldman Sachs. Sunil, good morning. Great to have you with us here. Good to have you back on the program, back on the channel. Sunil, let's just maybe start by looking at things through the lens of markets, from a market perspective. Do you think we are set for new all-time highs shortly? I mean, as some are saying, by Diwali. And maybe there are bigger gains in store. I mean, these things creep up on us. And before you know it, I mean, we're already up, as I was saying, about 1,000 points on the Nifty in the last 14 days. What's your sense? It's a slightly near-term question, Diwali and maybe by the end of the year, but what's your sense?
Look, Prashant, I mean, I'm not sure about Diwali or year-end, but look, I think we do expect further upside in equity markets in generally, including in India. I would say, I mean, obviously, we just had the Fed rate cut, but in general, if you sort of look at the global backdrop right now, you're kind of looking at U.S. economy slowing, but avoiding any outright recession. You're kind of seeing Fed cutting rates. We think they will do more, 2 more rate cuts this year, another 2 next year. So still more rate cuts to come, which means many of the EM central banks will continue to have some room to ease policy more. You got a dollar which has been weakening, and we think will further weaken from here in. So the setup is one wherein it should be generally pro-risk, right? Weaker dollar, rates being cut, growth kind of holding up in many places. And so that should be, people should be continuing to take risk in EM markets. And that's why EM, for example, is more than 20% up year to date. And we think investors will continue to take allocations in the EM equity markets, and that continues to play out. And in that, we think India will also benefit. And so we do expect markets to go higher. We do have a 27,000 target on Nifty on a 12-month basis, which from current level is still sort of mid-single to high single-digit gains. Whether that comes in a shorter period of time by year-end or Diwali, we'll need to see. But overall, I think given the macro setup, we think markets should still go higher from here.
Yeah, Sunil, hi, good morning. Great to have you in. I was thinking you'll sound even more optimistic because I was going back to our old conversation and I remember, and this was before the 15th of August speech and before the announcement of the GST cuts. And we were really, really optimistic on the second half, and you'd given us that target, 27,000 in the next 12 months. So I thought today you will, either increase that target or shorten the time duration, because now we have the GST bonanza as well. But still, on that comparison scale, still tempered. But tell us, I mean, your call on consumption spot on. But now how much more? Because stocks have also run up quite a bit since we last spoke.
No, I think that's a great question, Surabhi. Look, I think as you recall from the previous conversation, we were expecting a recovery in the consumption. We were already seeing a rural recovery coming through. And on top of that, you got the GST cuts, which I think means that consumption should be recovering in the next couple of quarters. And so we were, even before the GST cuts, we were kind of positioned that way in the market, in the sense that we were overweight the consumption pockets, and we continue to hold those views. I've been sort of running around in Asia, speaking to clients this week and part of last week. And I would say the consistent feedback around India has been that growth has been coming back, but it's still very concentrated in consumption rather than the rest of the pockets. And that's kind of our view as well. And there has been more going on in the rest of the EM pack, which is where the action has been. And obviously people are quite excited about the AI story. And you got the North Asian markets and China to play that. There have been sort of more catalysts in the rest of the EM in terms of corporate reform story in Korea, more excitement around Europe and the markets in there. And so I think the general feedback has been that India doesn't play into the AI story. You have consumption coming up, but you haven't seen much pickup in the credit growth. You haven't seen sort of IT obviously today is doing well, but it's still a US sensitive sector. And in the case that US growth is still slowing, it has come off in the last year, but people are still a little bit reluctant to take exposure there. And then given government has been consolidating on fiscal and they have given the consumption boost, the general sense is that they might moderate the infrastructure spending. And so you go through the sectors, it just feels like consumption is the bright spot, which we agree, and we are positioned there. But the other sectors might take a little bit more time, which is why the upsides is more kind of moderate in our estimates.
Sure. Sunil, so I'm just trying to understand that incrementally, when you map earnings now, overall for the market, for the wider index, or even for, let's say, consumption companies, Where are you at? And have those estimates been bumped up after the GST cuts? Some ranges or numbers would help here.
Yeah, I mean, that's a great question, Surabhi. So I think we have, I mean, obviously the second quarter reporting season was generally pretty decent. The bar was low, but I think we got the underlying earnings growth of around 12%. Our full year number for calendar 2025 is about 11% earnings growth, and we think we're kind of on track to meet those. We have started to see in the last couple of weeks sort of earnings upgrades in the consumption space, notably in staples, in discretionary. And so I think the sentiment is starting to improve. When you look at the broader market, there are still more downgrades that have happened in the last 1 month since the GST announcements. Then we have seen upgrades, which means the net sentiment is still sort of in the red zone, wherein downgrades are more than upgrades. But incrementally in the last 1 month, we have seen consumption pockets, people raising numbers. We think there's still more to go there, and so we can start to see more upgrades in the consumption sector. And as I said, we think we should be able to achieve that sort of 11-12% earnings growth, which is what we have. We also did some deeper analysis around the GST cuts and the impact of that on corporate earnings, and our sense was that I mean, obviously, you have to make some assumptions in terms of how much demand elasticity in different sectors. But our sense is that in general, it could improve India's earnings by 1 percentage point. It sort of looks a bit low, but it's because it's concentrated in consumption, and large parts of the other markets do not really benefit from GST. But net, that should be accretive for underlying earnings. We haven't raised the numbers a lot because some of that gets shaved in because of lower growth on the infrastructure side and the continued uncertainty around tariffs. So net, we still think overall there is a net positive earnings impact from the GST overall for the market.
Hi, Sunil. Good to see you. I remember exactly 12 months or so ago, we had quizzed you about the Chinese markets, and you said maybe the Chinese markets from 9.5 times could trade around 11.5 times as well. And that's what could cause them to, that index to do pretty well. And that's how it's played out, right, in the last 1 year. Indian markets, actually, MSCI India is struggling, while you have the MSCI Emerging Market Index that's done far better. So we have relatively underperformed. Give and take everything with the kind of action we have seen both on the fiscal and the monetary side. Do you think India gets to a stage now where we get back to market performance or maybe outperform? Point number one. And the second point is on the FI holding. They have been selling into the Indian markets non-stop. The holding in the Indian markets is the lowest we have seen in multiple years, and they're net short. Do you think it's reaching to a stage where we see that slow down a little bit at least?
Look, Nigel, I mean, you're exactly right. I think India is, depending on whether you look at MSCI India or Nifty and dollar or local returns, but India is flat to moderately down for the year. EM is up 25, 26 for the year. So you have sort of seen more than 20% underperformance for India. That's the largest underperformance India has seen on an annual basis in the last 30 years. So it's been a stark underperformance, and China has done much better. We were lucky in terms of our allocations that we were overweight China, we were overweight Korea. We downgraded India, as you may recall, back in October last year, so almost a year back. And so that relative call wherein China has outperformed, Chinese equities have outperformed Indian equities by almost 70 percentage points, has worked very well. So you're right in asking, and foreigners have sold, and are we at a point wherein some of the mean reversion can happen? I would say, look, I think the valuation premium has definitely come down. When China was at 9-10 times, India was at 24-23 times. You were looking at 100% plus premium. Today, that premium with China rallying and going to 15 times, with India being at 20 times, is sort of down to 30-40%. So we have seen a large compression in premium. But we do think, we are still overweight China. We think that momentum in China could extend for a couple of quarters. But at the same time, I think the catalyst for market rotation, so to speak, or India to outperform, has to come in from not just valuation coming off a little bit, but underlying growth and earnings improving. I mean, we obviously have a real GDP growth of still 6.5, 6.7 is where our forecasts are. But inflation is running pretty low, so the nominal growth is still at 8 handle. We think next year that goes to around 10 times, which is similar to what it has been in the last few years. So this year, obviously, the nominal GDP has been unusually low. That, along with the fact that consumption recovers and some of the other sectors, especially financials, we think will recover with a couple of quarters of lag. I think that could cause the market to do a bit better. But in the near term, we still think that some of the other markets, including China and Korea as a case in point, might have a better momentum compared to India. I mean, FII flows encouragingly in the last couple of weeks have been turning positive. But we'll need to see if that trend sort of persists. We see that across the EM complex, wherein flows have generally been positive because of the macro tailwinds. And I think what we are seeing now is India is also benefiting a little bit from that.
No, absolutely. I mean, the last few years, right? I mean, the best performing markets have been India and the US. I think recency is a powerful thing. You expect every year to be a big one, but it's turned out to be quite okay, and we're in September, right? Still a couple of months to go before we close this one out. Sunil, so how does one position one's portfolio? Financials is clearly an area you like, but if you can, I mean, talk about your published sort of names, or you want to go as close to names as possible, segments where one should look for opportunities in a positional way now.
Yeah. Look, I mean, Prashant, we can't talk about individual names, as you know, but I mean, in terms of sectoral preferences and segments, as I mentioned before, even after the personal income tax cuts that we saw through, we already had positioned in terms of liking the consumption sectors over investment sectors. And so we are overweight staples that should benefit from the GST cuts. We are overweight autos. We do pick up some of the QSR and the tourism and the internet names through the overweight and the internet or the TMT sector in general. We also are overweight financials. So I think financials and consumer sectors are where we have our sort of most positive views on. On the other side of the ledger, we are underweight infrastructure, excluding defense, which is a structural theme, but the rest of the infrastructure pack, we are underweight pharma. And so we have a clear preference of consumption over investments there. We are neutral IT, realizing that it has come off a little bit, but we think it may be a little bit too early to position there. The only incremental change I would say we have made after the GST announcement in terms of our sectoral preferences has been around the cement sector, which may be a bit sort of anti-consensus in the sense that obviously there is a GST benefit specifically for the cement sector, but we also think that they may be able to sort of hold on to or improve their margins given the industry setup. And property sector in general is still looking pretty decent. And so the combination of sort of benefits from the GST cuts with pricing power within the cement sector could do better. But overall, I think those are the pockets which we think outperform within the broader market.
Got it, Sunil. That gives us a good framework, at least, when an overall view on how you're thinking and positioned on the market. Just a clarification, this 11% earnings growth that you spoke of, that's for calendar year 25 or is it for FY 26?
Surabhi, this is for calendar year 2025. And as I said, we are halfway through or more through the year. We'll see how the third quarter reporting numbers come up, but we should be able to we are in line with those numbers. Just to sort of put that in context, we haven't sort of changed those numbers or felt the need to change a lot of those numbers through the course of the year. Coming into the year when we had a more cautious view on growth slowdown, we were still at 11-12%, or roughly at 11%. I think consensus at that time was 16-17%. Consensus has come down to our numbers where we, through a lot of changes, did not feel much need to change those numbers. But we do expect earnings growth to further improve next year, as in calendar 2026, from current 11% estimate to around 14% estimate, as some of these growth recovery comes through. And we think market basically on a 12-month basis rides those underlying earnings growth with a bit of multiple sort of compression from current levels, given it still looks expensive relative to everything. And how we sort of get to.
No, I'm glad you brought up that point because I was just leading into that. So I'm just reiterating for the benefit of our viewers. So 11% earnings growth this calendar year, 14% earnings growth in the next calendar year, 2026. And that really brings us back to the central point, Sunil, right? It's all about earnings. The day these earnings start really firing up, we'll see the FBI's return. I mean, they'll take their tactical calls again vis-a-vis positioning and valuation. So this 14% growth that you're talking about for the next year, This primarily you expect will be driven by consumption and financials, right? And those are your key overweights.
Right.
So what makes you optimistic? I mean, I know I'm being a bit of a naysayer here or whatever, but it's just that we haven't seen a broad-based pickup in consumption in so many years. The market's been completely pivoted towards capex. What will change? And the problem is that usually it's been wherever there are savings, it goes to a few discretionary stocks. It doesn't become a wide mass sectoral trend, right? So what makes you confident that that will change? It won't be just about 3 jewelry stocks and 2 real estate, stocks which go up on discretionary consumption.
You partly answered that question, Surabhi, there itself, because I think the pushback we were getting from investors, even during the recent marketing, is that, look, the GST cuts would be helpful, but does it sort of extend beyond a couple of quarters, and how sustainable could the pickup in the consumption be? So I would say make 2 points. One, I think the GST cut benefits come on top of the recovery we were already seeing in the ruler cycle. And so we were already therefore seeing not just the high-end consumption doing better, but signs of pickup in the mass market consumption. And I think GST at the margin kind of reinforces or accelerates those trends. There is also the difference between the earlier sort of VAT cuts or even the personal income tax cuts that were announced back in the budget versus the GST cuts that we have been making, is that the exact point you made, that when you have personal income tax cuts, that only benefits a small cohort of the population, whereas the GST cuts are actually much more wider. Everybody kind of benefits given, and it's across different segments. And so we think the impact of the GST cuts should be far wider than we have seen from personal income tax cuts, which obviously was a smaller segment, but also some of that was used in deleveraging household balance sheets. And this one we think should help a lot of the consumption categories. There's also a difference that in the previous instances of VAT cuts, you always had the entry for profiteering law, which means the companies had to fully pass that through. This time around, that's not there. So we think companies have more degrees of freedom in terms of how they pass these GST benefits, and in terms of price point packs and grammages increasing in the sense of higher volumes. In some cases, you do pick unorganized to organized shifts, and so you get some sort of premiumization come through. In some cases, you have better pricing power, and so you may be able to only sort of retain some of the margins. In some cases, you were already spending on marketing and expenses, and so with the cuts now, GST cuts, you may be able to retain, not spend as much, and that's expansion. So to a variety of models, I think there could be sustainable growth, a boost from the GST.
Okay, and that explains why you are so optimistic on consumption, not a small, narrow part of it, but, a pretty wide basket of the Indian consumer. Thanks very much, Sunil. Great conversation as always. You have a good rest of the day, and of course, we'll see you again soon.